Every time the market drops, I hear the same thing. Things like, I'm going to wait until the market settles down. And I get it. When the headlines are screaming and your account balance is dropping, sitting on the sidelines feels like the smart and disciplined move. It feels like you're almost protecting yourself. But here's what's actually happening when you wait for the market to feel safe before you invest. You're guaranteeing a bad outcome to avoid a possible one. Today, we're going to break down why saying things like it's too risky is one of the most expensive things you can tell yourself and what the data actually says about investing when the market feels scary. I'm Ken Erdman, financial planner and founder of Erdman Financial Group based in Lancaster County, Pennsylvania. Let's get into it. First, I want to say something very clearly. This feeling is completely rational. The instincts to protect what you have when something feels dangerous is hardwired into us. It's what kept our ancestors alive. It's not a character flaw, it's simply human biology. The problem is that financial markets don't work like physical threats. When a predator is chasing you, freezing or running is a good strategy, potentially depending on who the predator is. But when the market drops, however, freezing or running is almost always the wrong one. Here's what's actually happening in your brain when you watch your investments drop. Your amygdala, the part of the brain that processes fear, fires in exactly the same way it would if you were physically threatened. The pain of financial loss is neurologically real. Research has shown that the emotional pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. So a $10,000 loss hurts about twice as much as a $10,000 gain feels good. That asymmetry is why people sit on the sidelines. Not because it's a smart financial decision, because it's the comfortable emotional one. And comfort is one of the most expensive things you can buy with your financial future. Now let me show you what risky actually looks like when you zoom out. The US stock market has experienced major drops throughout its entire history. Crashes, corrections, recessions, pandemics, wars, or financial crises. Every time that those things happened, the instinct was to get out and wait. But every single time, the market recovered. Not just recovered, but it went on to reach new highs. Think about the 2008 financial crisis, the worst financial collapse since the Great Depression. If you had invested at the absolute peak before the crash and just stayed invested, you would have fully recovered within a few years and gone on to significant gains. Let's fast forward a little bit and think about March of 2020. A global pandemic shut down the entire economy. The market dropped nearly 34% in 5 weeks, the fastest crash in history. If you had panicked and sold, you locked in those losses permanently. If you had stayed invested, the market had fully recovered within 6 months and went on to hit all-time highs. Here's the core principle you need to understand. Risk in investing is not the possibility the market goes down. The market will go down. That risk is certain. The risk is the possibility that you don't recover. And for long-term investors, that has never happened in the history of the US stock market. The real risk isn't being in the market when it drops. The real risk is being out of the market when it recovers. So there's a well-known concept in financial planning worth knowing. Researchers have looked at what happens if you miss just the 10 best trading days in the market over a 20-year period. So over a 20-year period, there are roughly 5,000 trading days. Miss just 10 of the best ones, 10 out of 5,000, and your returns are cut nearly in half compared to someone who never left. And here's the part that makes it worse. The best days in the market almost always happen right after the worst ones. So the people who sell during the crash to protect themselves are almost always out of the market when the recovery happens. Waiting for the right time to get back in means missing the exact days that matter the most. So I want to reframe how you think about risk entirely. Most people think of risk as the market might go down, right? But that's not actually what risk is. That's volatility. And volatility is normal. Volatility is the price you pay for long-term returns. Every investment that has ever produced meaningful returns over time has done so with significant volatility along the way. Real risk, the kind that actually damages your financial future, looks like this. Things like keeping money in cash for years while inflation quietly erodes its purchasing power, selling during a downturn and locking in losses you never had to realize to begin with, or waiting on the sidelines for years for the right time that never comes while the market compounds without you. Those are the risks that actually hurt people, not the temporary drops that feel terrifying but ultimately resolve. There's a concept called opportunity cost, the cost of what you didn't do. Every year you sit in cash waiting for the market to feel safe is a year of compounding that you can never get back. And unlike a market drop, that loss is permanent. Now, I want to be honest with you about something. There is real risk in investing, especially if your time horizon is short. If you need money in 1 or 2 years, it should absolutely not be in the stock market. Volatility over a short-term period can genuinely hurt you and your accounts. But for the money that you don't need for 5, 10, or 20 years, the math is overwhelming. Time is the thing that turns volatility from a threat into a feature. The longer your time horizon, the less that those short-term moves matter. The more time you have, however, the more certain that history suggests that you'll come out ahead. Understanding this conceptually is one thing. Building a portfolio that actually matches your time horizon, your goals, and your risk tolerance for volatility is another. That's where working with someone comes in. Whether that's a full financial plan or simply having a disciplined investment strategy built around your life. Knowing what you own, why you own it, and what you'll do when the market drops is what separates investors who stay the course from the ones who sell at exactly the wrong moment. You don't need to have it all figured out before we talk. In fact, most people don't. You just need to be serious about getting there. So let me wrap this up. It's too risky is not a financial strategy. It's just a feeling. And it's a feeling that has cost people more money than almost any market crash ever has. The market will drop again. It always does. The question isn't whether you can avoid that. You can't. The question is whether you have a plan that lets you stay invested when it does, so you're there when it recovers. Volatility is the price of admission for long-term returns. Pay it willingly and stay in your seat. If any of this resonated, if you've been sitting on the sidelines waiting for the right moment, or you want to build a real investment strategy that you can actually stick to, feel free to reach out. I work with people at every stage of the financial journey, and I'm always happy to have that conversation. Link to schedule a call is in the description. If this was helpful, subscribe. New videos every week with no fluff, just real planning conversation for people who are serious about building something. I'll see you in the next one.